The notification appeared at 3:47 a.m. Eastern Standard Time. A single transaction. $17 million. From a cryptocurrency wallet registered to a shell company in the Seychelles, through a mixing service in Estonia, to a digital art marketplace in Singapore. The payment split across 47 different accounts within 6 seconds. By morning, the money had vanished into the legitimate economy like smoke through Venetian blinds. The FBI Cyber Crimes Unit would spend 3 years trying to trace those funds. They never found them. This is another video where money, power, and history collide. And nothing is ever as simple as it looks. We tell ourselves the dark web is a modern problem. A digital aberration born from encrypted browsers and cryptocurrency. We imagine criminal syndicates as tech-savvy outlaws operating from basement servers, laundering billions through Bitcoin exchanges and NFT marketplaces. The headlines paint a picture of innovation corrupted. Technology twisted into criminal enterprise. The story feels contemporary. Urgent. Unprecedented. But money laundering isn't a digital invention. Criminal syndicates aren't a cryptocurrency phenomenon. The dark web simply gave ancient human behaviors new tools. The scaffolding changed. The architecture remained identical. For 5 centuries, criminal organizations have moved dirty money through legitimate systems. They've corrupted banks, manipulated markets, and purchased respectability with surgical precision. The methods evolved with technology. The motivation never changed. Power seeks legitimacy. Wealth demands respectability. Crime requires laundering. The Vatican Bank understood this principle long before Satoshi Nakamoto wrote his first line of code. In 1982, Italian prosecutors investigating the collapse of Banco Ambrosiano discovered something remarkable. The Vatican's financial institution, officially known as the Institute for the Works of Religion, had been washing money for the Sicilian mafia through shell companies in Panama and the Bahamas. Cardinal Paul Marcinkus, the bank's president, created a network of offshore entities that would make modern crypto mixers look primitive by comparison. Roberto Calvi, known as God's banker, engineered the system. Money flowed from heroin trafficking in Palermo to construction projects in Rome through Vatican accounts that carried the moral authority of the Catholic Church. Who audits the Pope's bank? Who questions transactions blessed by cardinal oversight? The criminals understood something profound about human psychology. Legitimacy isn't earned through transparency. Legitimacy is purchased through association with trusted institutions. Modern dark web syndicates learned this lesson perfectly. Today's cryptocurrency laundering operations don't simply rely on technical obfuscation. They weaponize institutional respectability with devastating efficiency. The Lazarus Group, linked to North Korean intelligence, doesn't just steal cryptocurrency from exchanges. They convert stolen funds into shares of legitimate companies, donations to established charities, and investments in regulated financial products. The mechanism works like digital alchemy. Stolen cryptocurrency enters mixing services that fragment transactions across thousands of wallet addresses. The fractured funds move through privacy coins like Monero and Scash, where transaction histories become mathematically untraceable. Clean money emerges through decentralized exchanges that operate across multiple jurisdictions. But technology only handles the first phase of laundering. The real genius lies in legitimization. Criminal syndicates purchase non-fungible tokens from established art galleries, creating artificial market demand for digital assets. They bid against themselves using different wallet addresses, driving prices higher. The same stolen funds buy and sell the same digital artwork dozens of times, creating transaction histories that appear legitimate to automated compliance systems. The NFT sells for $10 million. The auction house takes its commission. The gallery provides authentication certificates. Everyone assumes the buyer earned their wealth through legal means. After all, who spends $10 million on digital art without proper documentation? Money doesn't just get cleaned through these transactions. It gets baptized. The art world became the perfect laundering venue because it operates on subjective value and privacy traditions. A cryptocurrency wallet registered to anonymous user 47BX891 can purchase a Bored Ape NFT for $3 million. The same wallet transfers the NFT to another anonymous address. That address sells the digital asset to a shell company in Delaware. The Delaware company sells to a trust in the Cayman Islands. The Cayman Trust liquidates the NFT through a Swiss auction house. 6 months later, the money appears in Manhattan real estate investments. Clean. Legitimate. Respectable. The system works because each institution maintains plausible deniability. The NFT marketplace claims they cannot verify customer identities due to blockchain privacy protections. The Delaware shell company argues they conducted proper due diligence on their corporate clients. The Cayman Trust insists their beneficial ownership information remains confidential under local privacy laws. The Swiss auction house points to their long-standing reputation for discretion. Everyone profits. No one questions. The money flows upward through society's most respected institutions. Gaming platforms became another perfect washing machine. Criminal syndicates purchase virtual assets in popular online games using stolen cryptocurrency. They buy rare weapons, character skins, and digital real estate that trade for thousands of dollars in secondary markets. The gaming companies process these transactions as legitimate entertainment purchases. The virtual assets transfer between player accounts through in-game trading systems that operate outside traditional banking oversight. A rare sword purchased with stolen Bitcoin gets traded 17 times across different gaming platforms. Each trade creates distance from the original theft. Each transaction appears like normal gaming activity to automated monitoring systems. The virtual sword eventually sells for cash through legitimate gaming marketplaces. The money enters traditional bank accounts as entertainment industry income. Tax authorities see gaming revenue. Compliance officers see digital entertainment transactions. Criminal investigators see nothing at all. The beauty of the system lies in its apparent inacuity. Who suspects money laundering in video game transactions? Who imagines international criminal syndicates hiding behind cartoon avatars and digital treasure chests? But the most sophisticated dark web operations learned something more profound than technical obfuscation. They learned how to corrupt the regulatory system itself. Compliance officers at major cryptocurrency exchanges receive thousands of suspicious transaction reports daily. The volume overwhelms human analysis capabilities. Criminal syndicates exploit this weakness by structuring their laundering operations to trigger false positives across the entire system. They create thousands of artificial transactions designed to look suspicious while remaining technically legal. Automated compliance systems flag these decoy operations, flooding investigators with meaningless reports. The real laundering transactions hide within the noise like submarines beneath surface storms. Money laundering became an information warfare operation. Criminal syndicates don't just wash money. They wash the attention of law enforcement agencies. The strategy works because it exploits a fundamental weakness in modern regulatory systems. Compliance officers assume that enough surveillance equals effective enforcement. Criminal organizations prove them wrong by turning surveillance against itself. More data doesn't mean better detection when criminals control the data. Cryptocurrency mixing services advertise their money laundering capabilities on traditional marketing platforms. They purchase Google advertisements and maintain customer service departments. They process complaints through Better Business Bureau registrations. Some mixing services even publish annual transparency reports detailing their privacy protection methods. The brazenness seems impossible. Criminal services advertising through legitimate marketing channels should trigger immediate law enforcement response. Instead, these operations persist for years while processing billions in illegal transactions. The explanation reveals something disturbing about modern regulatory systems. Law enforcement agencies cannot prosecute services that operate in legal gray areas across multiple jurisdictions. Cryptocurrency mixing might be illegal in the United States, but it remains perfectly legal in dozens of other countries. The mixing services simply relocate their operations to friendly jurisdictions whenever regulatory pressure increases. They're not hiding from the law. They're shopping for better laws. The global financial system inadvertently created a marketplace for regulatory arbitrage. Criminal syndicates don't need to break laws anymore. They just need to find countries where their desired activities remain legal. Money laundering became a legitimate industry in any jurisdiction desperate enough for capital investment. The Cayman Islands didn't become a financial secrecy jurisdiction by accident. They designed their banking laws specifically to attract capital that couldn't qualify for mainstream financial services. The same logic applies to cryptocurrency havens like Malta, Estonia, and Switzerland. These countries compete for criminal capital by offering increasingly permissive regulatory frameworks. The result creates a race to the bottom that benefits only the most sophisticated criminal organizations. Small-time criminals get caught by enhanced surveillance systems. International syndicates get welcomed by governments offering financial privacy protections. The names have changed since Roberto Calvi stuffed his pockets with bricks and walked into the Thames. The Vatican Bank gave way to cryptocurrency exchanges. Offshore shell companies became decentralized autonomous organizations. Swiss numbered accounts transformed into anonymous blockchain wallets. But the fundamental behavior never changed. Criminal syndicates always follow the same pattern. They corrupt legitimate institutions, exploit regulatory weaknesses, and purchase respectability through association with trusted brands. Today's dark web operations succeeded because they understood this historical precedent better than law enforcement agencies. While investigators focused on technical countermeasures, criminals focused on institutional corruption. While regulators built better surveillance systems, syndicates built better legitimacy pipelines. The most dangerous criminal organizations don't operate outside the system anymore. They operate from inside the system's most respected institutions. They don't break the rules. They purchase the right to rewrite them. The technology will continue evolving. Quantum encryption will replace traditional cryptocurrency mixing. Artificial intelligence will automate money laundering operations across thousands of simultaneous transactions. Virtual reality platforms will create entirely new venues for asset washing and legitimacy purchasing. But the essential truth remains unchanged. Money laundering succeeds because legitimate institutions profit from looking the other way. Criminal syndicates thrive because respectable organizations need their capital. The dark web prospers because the regular web depends on its liquidity. We built a global financial system that rewards willful blindness and punishes excessive curiosity. Criminal organizations simply learned to exploit our own moral compromises more efficiently than we imagined possible. The greatest lie about dark web money laundering isn't that criminals operate in digital shadows. The greatest lie is that they operate separately from the institutions we trust most. They don't hide from legitimacy. They purchase at retail, wholesale, and at institutional discounts. The dark web isn't an alternative to the regular economy. It's the regular economy's most profitable subsidiary.